Welcome back to the channel, everyone. In our last video, we talked about how to start investing even with a small amount of money each month. Today, we're diving deeper into one of the most common types of investing in the stock market. Understanding the basics of how the stock market works is crucial for anyone looking to grow their wealth long term. However, the world of stocks can seem complex and intimidating if you're just getting started. In this video, I'm going to break down the fundamentals in plain English and provide a step-by-step guide for getting involved in a simple, low-cost way. By the end, you'll have a solid foundation of stock market knowledge and feel ready to begin building your own portfolio. So let's jump right in. To start, it's important to understand exactly what the stock market is. In simple terms, the stock market is a collection of exchanges or marketplaces where shares, called stocks, of publicly traded companies can be bought and sold. When a company wants to raise capital to grow their business, they may offer shares of ownership to outside investors through a process called an initial public offering, or IPO. This allows everyday investors like you and me to own a small piece of large, successful companies in exchange for the capital they need to expand. There are two main stock exchanges in the United States: the New York Stock Exchange, NYSE, and NASDAQ. These exchanges provide a regulated marketplace for buyers and sellers to trade stocks electronically throughout the trading day. The price of each stock fluctuates constantly based on supply and demand as trades occur. Some of the most well-known companies trading on these exchanges include household names like Apple, Microsoft, Amazon, Google, and Coca-Cola. By purchasing even a fractional share of these companies, you become a partial owner and have the potential to profit from their success over time through stock price appreciation and dividend payments. Now that we understand what the stock market is, let's talk about the two main types of stocks you can invest in: common stocks and preferred stocks. Common stocks are the most widely available type and what most people think of when they hear the word stocks. As a common stock shareholder, you own a small piece of the company and have voting rights on major decisions. You also have the potential to profit from stock price gains if the company does well. Preferred stocks are similar to common stocks but come with some differences. Preferred shareholders have a higher claim on company assets and earnings than common shareholders. However, they usually do not have voting rights and their stock prices do not fluctuate as much as common stocks based on company performance. Preferred stocks often pay regular dividends at a fixed rate. Now that we've covered the basics of what stocks are and the main types, let's discuss some key stock market terminology. Stock price: the current market value of one share of a particular stock. Market capitalization: total value of a company's outstanding shares, calculated as share price x number of shares. Dividends: portion of company profits paid out to shareholders, usually quarterly for well-established companies. 52-week high, low, highest and lowest price a stock traded at in the past year. P/E ratio: price to earnings ratio, comparing stock price to company earnings per share. Yield: annual dividend income from a stock as a percentage of its current market price. Bull market: extended period where stock prices are rising broadly across the market. Bear market: extended period where stock prices are declining broadly across the market. Understanding these basic terms will help you evaluate stocks and read financial news more easily going forward. Let me know if any need more explanation. Now that we've covered what the stock market is and some key terminology, let's discuss why investing in stocks is so important for long-term wealth building. There are a few main reasons. 1. Growth potential: over the past 100+ years, the stock market has grown at an average annual rate of around 7–10%, including dividends, far outpacing inflation and fixed income investments like bonds or savings accounts. This growth compounds over decades. 2. Dividend income: many established companies pay regular dividends to shareholders from their profits. This provides a steady stream of income in addition to potential price appreciation. 3. Diversification: by owning stocks across different industries and company sizes, you can reduce overall portfolio risk compared to keeping all your money in just one investment or asset class. 4. Inflation hedge: stock returns have historically outpaced inflation over the long run, helping preserve your purchasing power for retirement. 5. Participate in economic growth: as the economy and corporate profits grow overall, your stock investments grow alongside them. So in summary, stocks offer an excellent way to grow wealth steadily through market returns and benefit from participating in the success of some of the world's largest companies. Of course, There is also risk, but that risk is reduced through diversification and a long-term buy and hold approach. Now that we understand why stock investing is important, let's discuss some options for how to get started in a low-cost, simple way. Open a brokerage account. Look for one with no account fees like Fidelity, Schwab, or Vanguard. Funding is as low as $1. Invest in index funds, low-cost funds that track the entire stock market like the total stock market index. Fees are typically under 0.1%. Use robo-advisors, automated services like Betterment or Wealthfront build and manage low-fee, globally diversified portfolios for you. Invest in ETFs, exchange-traded funds that track indexes commission-free at brokerages. Popular options include SPY, VTI, VU. Dollar cost average. Contribute a set amount each paycheck or month regardless of price to reduce volatility risk. Consider your 401k or IRA. Take advantage of any employer match in your 401k and the tax benefits of an IRA if eligible. The key is to keep costs low by avoiding individual stock picking or expensive actively managed mutual funds when first starting out. Low-cost index funds provide broad market exposure at a minimal price. Now that we've covered the basics and investment options, here's a step-by-step process for getting started with your first stock market investments. 1. Open a brokerage account. Choose one that suits your needs from the major low-cost brokers. 2. Fund your account. Transfer money from your bank account. Most allow transfers of any amount. 3. Choose your investments. Select a total stock market index fund or ETF like VTI for instant diversification. 4. Place your first order. You can buy partial shares of ETFs or full shares of mutual funds for as low as $1. 5. Set up automatic investments. Program regular monthly purchases to dollar cost average. 6. Monitor your portfolio. Check balances periodically but avoid chasing short-term moves. 7. Rebalance annually. Sell high and buy low to maintain your desired asset allocation. 8. Continue adding over time. Increase contributions as your income grows. 9. Consider tax-advantaged accounts. Use IRAs or 401 kiloseconds to reduce your tax bill. Following these steps keeps it simple and ensures you're well diversified right from the start. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals. Thank you for joining us on this journey of understanding the basics of stock market investing. We hope you're now equipped with the knowledge and confidence to start your investment journey. If you found this video valuable, don't forget to like, share, and subscribe for more financial insights. Stay financially savvy, and we'll see you in the next video.